So our next topic is income tax. Okay. So individuals are required to pay tax for their income, right? So the same way the businesses is also going to pay tax for their income generated. And their income that is generated is the profits that they earn from the business. All right. Now, what happens with sole traders and partnership? In case of sole trader or partnership, whatever tax they are going to be paid or whatever tax they are going to pay, it is over the individual rather than taking the business as a whole. All right. Okay. So instead of on the business, the tax is going to be on the individual. All right. Now, if this particular tax has been paid from the bank account of the business, then that means it is a personal liability, right? Okay, so for example, a sole proprietorship example. Let's just say Mr. A is a sole proprietor, and he is required to pay tax on his business, all right, or the profits generated from the business, all right. So if he is going to pay taxes on the profit, then since he is a sole trader, whatever profits he is being imposed over the tax, or whatever the tax is going to be on the profit, would be treated as an income tax. All right. Now, oftentimes what Mr. A would do is he is going to pay off that tax using his own bank account that is linked to the business, right? Okay. So that means he is going to withdraw money from the bank in order to pay the income tax. Okay. So that whatever withdrawn money he has would be treated as a drawings. Okay. And the same is for the partnership as well. So if any partner is going to pay the income tax using the firm's bank account, then it would be treated as drawings from the business by the owner. I hope you understand. Next is limited liability companies. Okay. So companies are always treated as a separate legal entity. All right. And if the company is going to generate profit or generate income, then the company is required to pay tax. Okay. Now this tax would also be taken into SOPL, that is the statement of profit or loss. Okay. And if there is any tax that hasn't been paid yet or it is outstanding, then it would also be taken in the liability section of statement of financial position, that is the SOFP. Okay. Now, this tax that the company would pay is going to be the income tax. Okay. Since it is charged over the income of the company, that is the profits. PBT, profit before tax. Okay. Now, this particular tax in UK is commonly known as the corporation tax. Okay. But it is rather an income tax, but in UK it is known as a corporation tax. And it is not necessary that we call it corporation tax. We can call any of the either name, that is corporation tax or income tax. Okay. Now, as far as FA is concerned, you don't need a tax knowledge. That is, you won't be asked in order to, go in detail how tax is being calculated. No, you are not required to do that. Either you would be given a tax amount directly, or you would have to just use a percentage over the PBT in order to find the tax liability. Understood? Now, there are various steps that is involved in recording the tax. Okay. So, the first step is at the end of the year, okay, if the income is there, the company is required to find the income tax, right? Okay, so the step 1 is this one. That is, at the end of the year, company should have an income tax computed and it should make it due. That means it is due for payment. Okay. Now, income tax is an expense. So, we are going to debit the profit and loss account. Okay. And income tax liability, however, is a liability. So, we are going to credit the income tax liability. Okay. So, the income tax expense or charges is expensed in SOPL, hence it is debited. And since income tax is a liability, it is credited over the SOFP. Okay. Now, step 2 is that when you have made the due of the tax, you're going to pay it, right? So, when you're going to pay it, you're going to have to give away cash. So, when the cash reduces, you're going to credit it. Okay. And at the meantime, you are simultaneously reducing whatever is being payable as a tax, right? So, income tax liability also decreases, hence you are going to debit it. This is the step 2 category, right? This is step 2. Now comes step 3. So often what happens is that we are not going to, compute the taxes correctly. Okay. So there might be situations where your estimates have been very high. There might be situations where your estimates have been very low. Okay. So, for example, you have estimated that your income tax is 10,000 for the year. Okay. So, accordingly, you have made adjustments in your FS. Alright. But when it was actually due or when it came the next year, you found out that your income tax was due by 10,500. That is, you have to pay 10,500 as an income tax. So, that means you have found 500 less in your estimates, right? So this particular situation is called as under provision. That means you have found less of what is actually due. All right. Now the other way around, that is, you have found or estimated that you have to pay 10,500, but when it came to the actual amount, it cost you only 10,000. That means you have found something higher than was actually due. So this is under provision, all right. And this particular situation, you have found more of the amount is the over provision. Okay. So when there is over provision, how do you treat it? This over provision, that means you have actually found something that is higher than actually due, right? So when there is over provision, you have to reduce your income tax liability because you don't need to pay that much, right? So when you reduce the income tax liability, you're going to debit it, okay? And this would give you an income generation, right? So unexpectedly, you have gained an income over the over provision tax, all right? So that particular income would be credited, income tax charge, clear? Now, when you consider under provision, it is just the opposite. That means your income tax liability is going to be increasing, so you're going to credit it, okay? And simultaneously, your tax charge as an expense would increase, right? So you're going to debit it. I hope you understand, okay? Okay, so in the previous video, we have said that whatever is being estimated as income tax and whatever is the tax liabilities that is actually due would be different, right? We never get it right, okay? So the basic idea behind the under or over provision is that we have to make these two things equal, all right? So in order to make these two things equal, we are going to provide for under or over provision, okay? So in order to do that, we are going to adjust our income tax liability for the year end before it is actually being placed into the SOFP, all right? So what do? We are going to take the current tax estimate, that is the estimate that we have previously recorded. We are going to take the total income charge that is actually due over the year, okay? And the difference would be the under or over provision, okay? And if it is, over provision, we are going to take a negative amount. If it is an under provision, you are going to take a positive amount, okay? Let's do test your understanding 7, and then you can do test your understanding 8 on your own. If there is any doubt, you can ask me right away, all right? So test your understanding 7. GB company commenced trade on 1st January 2004 and estimated that the tax payable for the year end 31st December 2004 was 150,000, right? So they have already computed or estimated the tax that is going to be due, that is 150,000, and it was for 31st December 2004. Okay, in September 2005 the accountant of GB company received and paid a tax demand for 163,000. So what happened here? So what the estimate was actually 150,000, but the what actually was paid off was 163,000. All right, for the year ended 31st December 2004. So what happened in 2004 December? You actually estimated an amount over 150,000 that was due. Okay, but in September 2005, when you were actually due on its payment, you paid 163,000. Okay, now at 31st December 2005, it was estimated that GB company owed 165,000 for income tax in relation to the year end 31st December 2005. So what happened? On 2005, it was estimated that $165,000 on income tax was due, and it was in relation to 31st December 2005. Draw up tax charge. Now see, we don't know the difference until we calculate that particular amounts or we list that particular amounts. All right. So draw up tax charge and income tax payable accounts for the year ended 31st December 2004 and 2005 and detail the amounts shown in SOFP and SOPL is our question. Okay, I hope the question is understood. Okay, so we know that all these things are given to you, okay, and you're going to find out your answer from these things. All right, okay. Now, what are they telling us to prepare? We are required to prepare a tax charge account. We are required to prepare a tax payable account. Alright. So, we are going to prepare these two things. And also, all these amounts should also be taken in SOFP and SOPL. That means we are required to prepare the extracts from SOFP and SOPL. Alright. Now, let's just start. So, the first account is tax payable. Okay, so for tax payable, so what happened was 31st December 2004, we have already estimated a tax. All right, it is 150,000, right? So if it is 150,000, what did we actually do? We actually made a income tax charge account, okay, and credit income tax liability account by how much? 150,000, because that is what we estimated. All right. Now, word of truth. This income tax charge is actually taken over which account or which statement? We are actually taking it over SOPL, right? Okay. Now, when we convert this or post this into the ledger, what are we going to do? We are going to take SOPL on the credit side. Alright. So, on 31st December 2004, we have calculated the P&L, that is the tax charge. Alright. The tax expense of 150,000. Alright. Now, we are going to balance it off. So, in 31st December 2004, we have a balance carried forward of 150,000. The total is same, 150,000. Okay. Now we are going to brought forward that particular amount, that is 31st December 2005. That, sorry, not 31st December, 1st January 2005. That particular balance would be balance brought forward of 150,000. Okay. Now we know that what actually went away is 163,000, right? So we paid 163,000. So when we pay, what happens is that we credit bank account by how much? 165,000, because that is what we paid. And we are going to debit income tax liability. That means it has reduced. Okay. And it is 165,000. So what is the problem? The problem is such that, okay, these two things, that is, what we made due was 150,000, but what we paid was 165,000. Okay. So that means there is an under provision of the calculation that we have made, right? I would correct this. Sorry, it is actually 163,000. Sorry about that. So this is 163,000. All right. So what we paid is 163,000. What was actually due was 150,000, right? So in between this, we actually didn't show a $13,000 that was due, right? So this difference is under provisioned actually, because we paid 163,000. What we have shown is only 150,000. So 13,000 is our under provision. Understood? So when there is an under provision, your income tax liability should increase by 13,000 in order to reach that amount, right? So you're going to credit it as under provision. Okay. And this under provision would be $13,000. Okay. Now the balance carried forward would be, we haven't actually given the amount that we paid, right? On September 2005, we paid how much? 163,000. All right. Okay. Now we are going to take the total. All right. So before taking total, there is an information that is given to us. We'll look into it. All right. So the information is such that, okay, the closing balance or the closing, what is to be taken in the SOPL is already given to you. That is 31st December 2005. Okay. You have already been given an estimate of 165,000, right? So you're going to take it there. So 31st December 2005 in SOPL, okay, that is in profit and loss account, you are required to take 165,000. Okay. Now what you're going to do is you're going to total everything down. Okay. And you're going to take the balance carried forward on 31st December 2005, and the balance carried forward would be 165,000. Okay. And the total of everything would be 150,000 plus 13,000 plus 165,000. That would be 328,000. Okay. So that is our, the end result is also that we have to brought forward the carried forward, right? So 1st January 2006, your balance brought forward would be 165,000. Okay, and again, when the information is available, you are going to continuously keep it updated by giving an under or over provision. Okay, so the next account is the tax charge. Sorry. And tax charge is an expense and it is going to be taken into SOPL. Alright. And as you have seen the double entry, tax charge is something that is on the debit side. Okay. So whatever comes opposite of it, we are going to take to the debit side, that is the income tax liability. So on 31st December 2004, we have estimated an income tax liability. Sorry, instead of income tax liability, we have to mention it as tax payables account, okay, since it has been taken as tax payable. So tax payable account is of how much? 150,000, and same is going to be transferred to P&L. That is 150,000. Okay, and the total is just same all over. Okay, now in 2005 what happened? We had an under provision, right? Now you must understand, tax charge is an expense account. Okay, so however it increases, we are going to take it on to the debit side. I mean, whatever it increases with, it is going to be taken on the debit side, and whatever it is being decreased with, it is going to be taken on the credit side. All right, group 2 account, group 1 account. All right, so in 2005 we have under provision. That means we have to increase our tax charge. So under provision is taken on the debit side, and it is 13,000 as we have calculated before. All right, and the tax payable was actually 165,000 for the year. Okay, so how much have we taken into the P&L in total? The total of these two, that is under provision and tax payable, and that would be 178,000. Okay, it is done. Now we have to prepare extracts of SOPL and SOFP, right? Okay, so the extracts of SOPL and SOFP is below. All right, first let's take SOFP. Okay, so in SOFP we have 2004 and 2005. Okay, and in 2004 the income tax liability that we estimated amounted to 150,000, and in 2005 it is 165,000. Any adjustments would be taken in SOPL, right? So in SOPL we take it as tax expenses. Okay, and this comes after the profit before tax. All right, so in 2004 we have estimated it to be 150,000. Okay, and in 2005 we have estimated it to be 178,000. We are just going to take it. Okay, so that's all for the question that you are required to prepare. Now do test your understanding 8 and ask me if there is any doubts.